For decades, tax and financial advisors have helped their clients set up complex structures so that they can avoid paying their fair share of tax. This is a money spinner for tax experts, intermediaries and their customers, but not for anybody else. That's why selling this kind of advice has to become more open and transparent. In future, anyone selling harmful tax avoidance strategies will have to come clean and notify the tax authorities. And if you're clever enough to design your own schemes, you'll have to tell the tax authorities yourself.
That's the European Commission's clarion call for consulting firms, banks, lawyers, tax advisors, accountants to prevent another Panama or Paradise Papers. Hello and welcome to Bloomberg Quint. You're watching The Fine Print. The European Commission has recently proposed a set of draft rules that will require intermediaries to report schemes designed to reduce their clients' tax bill. The aim is to tackle tax abuse and ensure fairer taxation. The OECD too has proposed model rules that require tax advisors to report schemes that hide offshore assets and their owners. So how should tax advisors prepare for this changing paradigm? To answer that, I have with me well-known international tax expert Philip Baker and Mukesh Butani of BMR Legal. Gentlemen, welcome to the show. Mr. Butani, I'd like to start with you. The OECD has proposed these rules as part of its base erosion and profit shifting or BEPS action plan. India has been incorporating the BEPS proposal in its law from time to time. Now, among those is the common reporting standard that encourages countries to automatically share tax information with each other. In terms of the scope, is the OECD expecting intermediaries to share information that falls under the common reporting standard but isn't reported by companies?
Well, I think, we may perhaps be reading too much into the OECD model that has been released. Firstly, by way of background, in Action Point 12, it was clearly identified that there would be certain model standards that would be released and an option be given to countries to what extent they want to adapt such that they align those standards with their domestic regulations in general, and in particular with regulations such as the General Anti-Avoidance Rule, which are a part of the domestic law. Now there is some form of a framework that's available for countries to adapt these standards to make the intermediaries, including tax advisors, accountable, or rather responsible for certain forms of planning ideas which could potentially be questionable, keeping in mind the larger interest of the BEPS project and keeping in mind in particular the fourth cornerstone of the BEPS project, which is all about transparency.
I'll come to the implementation in just a bit. Mr. Baker, the European Commission has also come out with its own version of draft rules. Some of the examples that they have listed in terms of reportable structures include cross-border payment to a recipient resident in a no-tax or almost no-taxed country, transactions involving a jurisdiction with inadequate or weakly enforced anti-money laundering legislation. How is the scope of EU rules different from what the OECD has recommended?
Well, you've got to understand right at the beginning that the OECD model rules and the EU draft directive are actually targeting two quite different things, different but related. The OECD rules are concerned with schemes to avoid the impact of the Common Reporting Standard. The Common Reporting Standard is the standard for the automatic exchange of information. Starting this year, countries have begun to exchange immense amounts of financial information about individuals, taxpayers, other citizens from country to country. And the OECD have clearly heard that there are people designing schemes that avoid the Common Reporting Standard. I'll come back to that in a moment. the EU has adopted a draft directive, or rather there is a political agreement to adopt a draft directive which is a continuation of something we've had in the United Kingdom for over 10 years, and that's the disclosure of tax avoidance schemes. So if somebody devises a tax avoidance scheme, they have to disclose that to the revenue authorities.
Okay, Mr. Baker, I want to take this conversation forward in terms of what sort of structures will be impacted. Mr. Butani, the OECD rules expect tax advisors to report arrangements that have been designed to circumvent the common reporting standards. To your mind, has the net been cast too wide, and how will these intermediaries assess what kind of structures or arrangements need to be reported?
Well, that's for the individual countries exactly to decide. And that has also been stated in the release that OECD has made, that what kind of structures have to be reported has to be specified by the country, and then the sharing of information will work. So let me give you a couple of examples, and maybe I'm drawing parallel to the provisions under the Indian Income Tax Act. So if you look at the amendment that was brought about in, I think, 2015 or 2016 budget, it provided a simple requirement that when you file a tax return in India, and if you're a resident individual, you need to disclose the details of your foreign bank account, which has now become a practice. We had legislation by way of place of effective management, by which certain forms of income are brought to tax in India because the place of effective management rules. However, we do not still have anything in the domestic statute which imposes an obligation on the resident to disclose if he is a beneficial owner in a foreign trust. This obligation is there under our exchange control laws, but not on our tax laws. So some of these forms of disclosure can come about as an integral part of the tax statute or as a part of the subordinate legislation, and countries and jurisdictions such as India will try and derive some degree of strength and confidence, or rather empowerment, I must say so, with the recently released OECD standards on the common reporting standards.
The common reporting standard is appallingly badly drafted. The OECD were very lazy when they drafted it. Basically, the approach that was taken started with the US FATCA, foreign account legislation, which was concerned with targeting undisclosed bank accounts that US citizens had outside the country. And that approach, which really wasn't suitable, was used as the basis for the common reporting standard. As a result, the CRS has weaknesses and it has gaps. There are a number of types of non-reporting financial institution, and I assume that a number of these schemes that the OECD have identified draw upon those non-reporting financial institutions. But the second question you can ask yourself is, why do people want to avoid the common reporting standard? Well, one explanation is people are still hiding undisclosed money from tax authorities. But it also may be the case that people are very scared of the common reporting standard, that the lack of safeguards, the lack of data protection, they anticipate much of the information that will be exchanged with regard to some countries may well be leaked, and so personal financial information that should be protected by confidentiality will be leaked through this common reporting standard system. And one suspects that some people have been attracted to arrangements that avoid the common reporting standard specifically because they are worried about the almost certain existence in the future of leaks of the information that have been exchanged.
Okay, Mr. Butani, let me come to you in terms of what this means for the confidentiality privileges that have so far existed between companies and their tax advisors. The OECD rules state that an intermediary is not required to disclose information that is subject to obligatory professional secrecy rules. And at the same time, you're asking these tax intermediaries to come to you and disclose the structures that could potentially be aggressive. Aren't these stipulations sort of contradictory in themselves?
Well, yes and no. I think if you're alluding on to confidentiality clauses insofar as engagement letters with advisors are concerned, it would continue. If you're alluding to certain specified professional standards, such as the ones that are applicable to lawyers, such as client-attorney privilege, will they be overridden? The answer is no. But yes, it could cause friction, particularly since you are imposing an obligation on an intermediary which comes in conflict with the professional standards. So I think countries will have to be very, very careful when they bring about a list of transactions that need to be reported. Let me go back to this example of disclosing information on foreign bank accounts. So if you are a tax agent in India, providing tax return preparation services, and you're expected to know that a resident Indian has to disclose the foreign bank account, in which case you can hold the tax return preparer or the agent as responsible. That's a very, very simple example, but there can be all kinds of situations.
Sure. Mr. Baker, final word to you on how should tax advisors, banks, lawyers prepare for this changing paradigm in the light of the OECD model rules as well as the EU draft directive?
Well, can I first of all comment on the question that you put to Mukesh about the obligations of confidentiality on lawyers? The way that the CRS model rules get around that is by saying that if the disclosure of the information would otherwise breach legal professional privilege, then the obligation to disclose defaults to the customer who has bought into the scheme. That's, if you like, a workaround the professional privilege issue that was invented in this country about 15 years ago. Lawyers in the Law Society were worried that they might have to disclose tax avoidance schemes and that would be a breach of privilege. So they came up with the idea of the obligation defaulting to the client. Either way, there is an undermining of the obligation of confidentiality owed by a client, a lawyer, to their client. One of the concerns that I have with all of these developments is that there is a failure to recognize that there is essentially a right to take legal advice. And the lawyer should not have to either disclose the nature of that advice to a government body or tell the client, well, I don't disclose it, but you have to disclose my advice.
Mr. Baker, whether we like it or not, looks like, countries who've signed up on the OECD BEPS action plans and even the EU member states, for all of those tax intermediaries, this is going to become a reality. So what should they do to prepare for this changing paradigm of reporting, aggressive structures to tax authorities?
So far as the OECD model rules are concerned, and they're the only ones that are likely to come in with effect from India if the Indian government decides to go ahead, I'm not at all certain that there are people who are sitting there devising ways to avoid the exchange of information under the common reporting standard. There may be people who are saying this particular type of pension scheme, investment scheme is a non-reporting scheme, and clients may well be saying, that's useful to know, but I don't believe that there is any evidence that this activity is really going on. For those, if it has been going on and there have been people who've been involved in that, well, they will know what they must do in terms of disclosing of schemes. But I've seen no evidence presented by the OECD in any way to support what they have proposed. I think what they're realizing, they're effectively admitting, is that there are serious weaknesses in the drafting of the Common Reporting Standard, and rather than addressing those weaknesses, they are putting an obligation on intermediaries to do the notification if intermediaries meet the hallmarks of the model rules.
Sure. Mr. Butani, last word to you. How do you see these OECD model rules being implemented in India, and how soon?
We already have certain stringent provisions for prosecution within our income tax statute, and it totally unintended, but if we try and go ahead and impose these forms of onerous obligation on intermediaries, I think the consequences of that under the statute, which provides for prosecution of tax agents and people who are responsible for maintenance of books of accounts. There are 2-3 provisions in the final chapters of the income tax statute that needs to be dealt with. They all fall in the prosecution category. That's the second part. The third part, which we have never debated in India, and there's been a huge debate all across the world, and this is close to Philip's heart, is the taxpayer's right. And the taxpayer's right is, in my view, a all-encompassing right. Regrettably, the OECD guidance has not mentioned about what are the taxpayers. They talk about the taxpayers' duties and obligations. They don't talk about the taxpayer's right. The taxpayers do have a right, and let Philip have a final word, because he was the general reporter in the Basel conference.
Yes, absolutely. I completely agree with Mukesh. Taxpayers' rights are not being adequately respected. There is nothing said in the OECD model rules about the rights of taxpayers to take advice, to act on that advice. And more generally, underlying this is a failure to respect the right of confidentiality and the right of privacy and data protection of taxpayers.
Well, I hope that domestic laws will take care of some of these concerns that you've pointed out. Mr. Baker, Mr. Butani, thank you for joining me with your views on the changing rules of the game for tax advisors.